So good afternoon, everyone. I'm so pleased to have Winthrop Capital Management with us. We've got Greg Hahn and Adam Coons, and they are the managers of many of our clients' ETF exchange traded fund portfolios. And I want to hear from them, anxious to hear from them, how they survived the third quarter and also their reaction just to the last 2 days of the market. I should say the S&P 500 up about 5%. So I feel like over the last quarter, I've got a few more grays in my hair. It was really rough. What do you guys think? You're looking back on the quarter.
Well, let me start this off and turn it over to Adam, but someone had to blink. And I think in the last week, it was the UK central bank that blinked. And what I mean by that is the amount of stimulus that's been put in the markets to support the capital markets since the financial crisis has really helped support all of these great returns investors have had over the last couple of years, except for 2022 when our Federal Reserve said no more. We're going to start to increase short-term rates to start to fight inflation, and a little late, by the way, on the inflation thing. But in an effort to build credibility, they've been pretty adamant about we're going to keep pushing rates higher and higher. The problem is every time they push rates higher, the dollar gets stronger, and the impact on global currencies has been extremely punitive. And so it's countries, it's not surprising. Countries are saying, hey, can you back off a little bit? Well, what happened with the UK, they have a new prime minister. The new prime minister comes in with an agenda, and the markets didn't like it and just totally imploded. And the UK central bank said, we will step in and support the capital markets at every cost that we need to in order to get stability. And that's what investors were looking for. And that's what investors are looking for here in the United States also. So we still have some rough patches to go through because we got third quarter earnings to digest, and there are going to be some challenges. But I think that was the relief rally that we've seen in the last 2 days. Adam, what would you say about that?
Yeah, and I'd say since the UK pivot this week, what's really driven the rally is that sentiment that the Fed would pivot. So on Monday, we got an ISM number that approached 50, which if it falls below 50 is kind of a recessionary indicator. And then today, job postings declined by 10%. So we've reached this pivot in the market where bad news is good news because it means that bad news means that the Fed might actually back off on their tightening policy. So it's kind of a wacky market right now.
What should investors be thinking about between now and the end of the year? And then my other question is, how are you thinking about the portfolios, and are you doing any repositioning?
Yeah, two good questions. The first is investors need to be thinking about valuation. So what we've experienced so far in 2022 is literally a readjustment in the level of risk, the price of risk, and that's translated to valuation changes. So we came from what was 20 times PE on the S&P 500 down to something that's closer now to 16 times, which is more in line with historic averages. That's fair value. That doesn't mean it's below value, but at the end of the day, valuation matters. And so that's the first thing we think investors should look at. Adam, what else?
Yeah, and I'd say the second thing is just inflation obviously has been the big narrative. And so focusing on what those drivers are and how they're shifting. If you look at the CRB index, which is the commodities index, is back at its 12-month lows. Yesterday, there was a story in the journal about the price of shipping containers across the Pacific has dropped dramatically, and we're seeing used car prices drop. So we're seeing a lot of signs of those inflationary pressures start to shift. I think housing will be probably the last shoe to fall, but we should see inflation start to roll over pretty significantly.
So then, what do you think the Fed's going to do with interest rates?
So this is anybody's guess. The narrative, and that's what they have really, is the biggest tool in the toolbox is their ability to talk to the markets. The narrative is they want the market to believe they're going to keep pushing rates up to fight inflation, to put the rate of inflation lower. The reality is, I personally don't believe that they can really follow through with two more large increases, and that they need to let time just let it sit, because if you look at the forward CPI 1 year out, it's already, what, Adam, 5%?
Yeah.
So forward inflation's already coming down. So for them to
Okay.
shift to a narrative now that says we're just going to stay put and watch it and we'll move accordingly, I think would be appropriate.
And then, and back to how you're repositioning the portfolios.
Adam, go ahead.
Yeah, so the two big things separate the components of fixed income and equity. So on the fixed income side, we've incrementally been extending duration. So we hit 4% on the 10-year last week, and through that period, we've been extending the duration. We've had a short tilt, meaning that our portfolios have outperformed just the generic ag as interest rates have risen. And so now we're trying to basically move towards taking on more interest rate risk. Really, when you look at the risk, interest rates have more downside with yields coming down than they do to the upside. So we want to capture that. And then on the equity side, this last week we added to growth. And so we're just incrementally. This is kind of it's more or less a rebalancing of the overall portfolio. But when we're doing that, we're shifting away from defensive and more into growth. And so a great example would be, let's say your portfolio should be 60% equity. And half of it was in defensive and the other half was in growth. We may have shifted to 55% growth and 50% defensive, or 45% defensive. So in the rebalance, we actually tilted it more towards growth is what we've done this last week.
Yeah, I feel like the most exciting thing I did last week was buy 4% treasuries.
Courtney, on that note too, is for investors that are in separately managed accounts that are just bond portfolios, you can literally put together a municipal bond portfolio that's high quality that yields between 4.25% and 4.5%.
So
we haven't had markets to be able to earn that.
Yeah, and just doing a review with a client who has the moderate portfolio, very disappointing in terms of the returns so far this year. In your opinion, what's your opinion of the 60-40 equity bond portfolio?
So in the way the machine works today, the bonds and stocks are correlated. They're more correlated today than they have in the last 50 years, which means when risk is on, everything goes up. When risk's down, everything goes down. The 60-40 concept was built back in the early 1980s, where you could put a balanced portfolio together that moved differently. You could take profits, reallocate, and vice versa. So you could always build wealth because you were pivoting. When everything's moving in the same direction, it's hard to sell something to buy something if they're both down. And that's what investors are going through in the whole 60-40 mix.
Yeah, but it's not dead. It's going to work itself out eventually.
Yeah, I think we still believe in a diversified portfolio, and I think what we're doing in our model portfolios for you are examples of that, because it's not just the aggregate, the broad market index. We've diversified around it to help build some defense so that we can shift and make some changes that are going to be more opportunistic. So I don't think the 60-40 is dead, but that's a context of why it's working differently today, is because it's either risk is on or risk is off, and you're either in the market or you're not. So
okay. And so my last question for you guys, what's your take on the energy sector right now?
Yeah, I mean, it falls into the inflation story first and foremost. So I think if we think that consumer demand generically across all sectors is going to fall, then you would expect that energy would also fall. And energy tends to kind of be that lagging indicator, right? You see it kind of hit its peaks when the economy has essentially peaked, and then finally it rolls over as consumers can no longer afford these high prices. So I would expect it to come down. Obviously, we have some external issues that are driving oil prices right now. So if you obviously with the conflict in Russia as a big part of that adds a big variable to it. But I would say the overall market, if you just exclude that piece, which I know is difficult to do, I think you would see energy prices begin to come down.
Great. Awesome. Well, thank you so much. I like your perspective, and thanks for joining me today.
Thanks, Courtney.